Okay, so we lost the connection, but we can continue. So gain from the sale of an asset, gain from the sale of an asset. So we have it here. It is the 90. The 90. Now that is the gain. So it was added. We need to deduct it. So the gain was added. We need to deduct it. Then you have the finance cost. It was 1410. That one you can check it in the income statement. Those are the non-cash items that required adjustments. So let us add them together: 16,780 plus 10,980 plus 1080 minus 1090 plus 1410. That is 29,160. 29,160. Now, once we have this one, is it correct item? 16,780 plus 10,980 plus 1080. We have government grant actually somewhere. So we have government grant somewhere. We have omitted government grant. Government grant is supposed to be 1,500. So we are supposed to deduct 1,500. Then gain, which is the 90. So the gain was added, we need to deduct. Then finance cost is 1410. So finance cost is 1410. So the government grant, this one, the 1,500 was added. So we need to deduct. So 16,780 plus 10,980 plus 1080 minus 1,500 minus 1090 plus 1410. That is 27,660. 27,660. That one is correct. 27,660. Once we have that one, we can go look for working capital changes in working capital. So working capital changes. Working capital changes. So working capital changes. So we start with the first one. We have current the current assets, and the current assets specifically we shall look for the inventory. So from our inventory, you can see that the inventory increased from 24,890 up to 28,600. So we have an increase in inventory. Increase in inventory. So let us see the increase amount. So 28,600 minus 24,890. 24,890. Then we have also increase in receivables. Now the receivables increased from 14,160 up to 18,460. So we have an increase 18 for 60, 14,160. Then we also have payables, the current liabilities. We also have an increase. It increased from 17,540 up to 22,400. So increase in payables. Increase in payables. So increase in payables. So 22,400. 22,400. 17,540. 17,540. Let us see the difference. So 28,600 minus 24,890. So it's an increase. So an increase in asset we deduct. So meaning they purchased more inventory. 18,460 minus 14,160. We also deduct 4,300. Then an increase in payable we are supposed to add back. 22,400 minus 17,540. 48,60. Now when a payable increases, it means we have not paid. So in short, we have not paid. But once we pay, it means it's a decrease. So in this case, we are supposed to add it back. Now let us see. So 27,660 minus 3710 minus 4,300 plus 4860. That is 24,510. That is bringing us to 24,510. 24,510. 24,510. We call it gross cash flows from operation. Then we are supposed to less tax. We less tax paid. And we also less interest paid. So tax paid, we have it here, 3270. And then interest, so it was 1410. Here it is 1410. The other side. So let us do it. Let us do it that one faster. So 24,510 minus 3270 minus 1410. That is 19,830. 19,830. That is cash flow. Net cash flows. Net cash flows from operating activities. We call it A. So that is 19,830. You can go to the next one. The next one you can go, it is the cash flows from from investing activity. Cash flows from investing activities. You can start with the common ones. We have the cash purchases from the PPE. Cash purchases from the PPE. The amount was 22,910. So it's a purchase, so it's money out. We also have acquisition of intangible asset. Acquisition of intangible assets. So acquisition of intangible assets, here it is 2280. Then you have proceeds from sale of an asset. Proceed from sale of assets. So proceed from sale of that one, 40, we have it here. Proceed is 4020. This one is supposed to add back. What else do we have? We have the what else? So we have the government grant. We have the government grant also. Here proceed 3,000. Proceed from the government grant. From the government grant, which is 3,000. I think there is no any other item in that case. So we can get the actual figures. So we call it the net cash flow from financing activity, from investing. Net cash flows from investing activities. So how much would that be? Let us see. Minus 22,910 minus 2280 plus 4020 plus 3,000. That is minus 18,170. That will call it B. Then you go to C. The C is the cash flow from financing activities. Cash flows from financing activities. So we start with the issue of shares. That is the common one. Issue of shares. And we had two items, 1800 plus 1800. Here it is. So 1800 and 1800. That is an issue. So it's an increased money in. That's 600. We have dividend paid. Dividend paid. Dividend paid was 6,900. We also have interest paid. Interest paid is 1410. So sorry, after I look at this one because interest so hii tabaki tumeshaweka pale juu. So tumeshaweka the interest paid tumeshaweka hapo. So no need to repeat it. You don't have to repeat it again. Now we can look for other item now from our statement. So the other items that we can check is we can check on our equity component. Equity component is okay. We have completed equity. We can check for non-current liabilities. So we have the loan note. So we have the loan note. Loan note. So we check the balance at the beginning and at the end. So the balance at the beginning was 10,500. At the end was 16,500. So we have an increase. So 16,500 minus 10,500 at the end. But don't forget to deduct that amount for acquisition. This one also involves the loan amount minus 3,000. That's 600. So how much is that? So that will be equal to 16,500 minus 10,500 minus 3,600. That is 2,400. 2,400. So that it was an issue because it was an increase. So it's an issue. Then we have another item there, government bond. Government bond. So we have government bond. Bond. So it was an increase. So meaning the money was money in. So 1620 minus 1200. It's a proceed. So it was 1200. It can increase to 1620, meaning likelihood is that you have received money. So 1620 minus 1200. That is approximately 420. 420. I think that is all about it. I think that is all about it. There's nothing else. So let us balance it. So tutasema that 600 minus 6900 plus 2400 plus 420. That is minus 480. So that is minus 480. So we call it net cash flow from financing activity. Net cash flows from financing activities. And we call it C. So we call it C. So up to that point, I think we are good. Then after that point, now we can get the net cash and the cash equivalent. So we get net cash and cash equivalent. Net cash and cash equivalent. That is A plus B plus C. Utapata hapo. Then cash and cash equivalent at the beginning. Cash and cash equivalent. Cash equivalent at the beginning. Unaweka hapo. Then cash and cash equivalent at the end. Equivalent at the end. That will be the end. So cash and cash equivalent at the beginning, you check it in the balance sheet. So if you go back to our balance sheet, the cash and cash equivalent at the beginning, the balance for the cash and the current asset is 1020. 1020. Then at the end it's supposed to be, at the end, where is it? It's supposed to be 2200. 2200. Meaning the net cash, now the net cash, remember the net cash and the cash equivalent, when you take the net cash and the cash equivalent, you add the cash at the beginning, you're supposed to get the cash at the end. So let us confirm. So we need to take A plus B plus C to get that one. So let us add them. 19, 30 minus 18, 170 minus 480. So I'm getting 1180. I'm getting a figure of 1180. Now when I add the 1180 to 1020, so when I add now this figure, this one, I'm supposed to get the balance at the end. So 1180, now I add 1020. That one is correct. So that's how you're supposed to handle this question for April 2025 for the cash flow statement. So that's how you're supposed to handle that question. So when we meet again, we are going to do the next sitting from this sitting. That was for December 2024. December 2024 will be our next class. So up to now, I want to wish you well. We meet in our next class.